We're breaking down the Q1 2026 reports from Carlsberg Brewery Malaysia Berhad. If you want to understand how a massive consumer business navigates all this global uncertainty and still comes out on top, well, you are definitely in the right place. To start us off, I actually want you to think about this question for a second. How did a simple shift in the calendar lead to a multi-million ringgit boost for a brewing giant? I mean, it sounds almost too simple, right? But as we peel back the layers of Carlsberg's first quarter performance for 2026, we're going to see exactly how they captured this unique opportunity and just turned it into serious bottom-line success. Okay, let's dive right in. We've got 5 key areas to cover today. First, the Q1 2026 financial highlights, then the massive Chinese New Year catalyst, followed by a regional performance breakdown, what this means for shareholder value and dividends, and finally their sustainability and future outlook. All right, moving to Section 1, Q1 2026 financial highlights, focusing on the top and bottom line beats. First up, let's look at the top line. Carlsberg Malaysia's group revenue grew by a really healthy 6.5% compared to the exact same quarter last year. That actually brings their total revenue for the quarter up to a massive 705.9 million ringgit. To put that into perspective, that is a tremendous volume of beverages moving through the market right at the start of the financial year. And the best part? This wasn't just some top-line vanity metric. It translated directly to the bottom line. Group net profit saw a really solid growth of 4.7%, hitting 98.9 million ringgit. Expanding revenue and profit simultaneously, especially in a cautious consumer environment, that proves their internal execution is totally dialed in. It's definitely no easy feat when everyday shoppers are kind of tightening their belts right now. And if we look right at the data from their official Q1 2026 review of performance, it's basically a sea of green. You've got revenue, profit from operations, and associate profits all pointing up. It's a comprehensive, across-the-board beat that really just shows a well-oiled operational machine at work. Next up, Section 2, the Chinese New Year catalyst and the sheer power of the calendar. So what exactly fueled this surge? Well, if you look back at previous cycles, Carlsberg occasionally faced this squeezed timeline where festive sales actually fell into the preceding December. But Q1 2026? Completely different story. They were heavily boosted by a much longer selling period ahead of Chinese New Year. They literally just had more runway for consumers to stock up and celebrate. And honestly, their execution during this expanded window was basically flawless. Plus, they didn't just sit back and rely on their classic lineup. They capitalized on this festive window by launching Somersby Shandy in Malaysia and Singapore. It perfectly targeted that exact demand for easy, refreshing drinks during the celebrations. And the response was wild. Most retail outlets sold out within weeks. They clearly brewed exactly what the market was thirsty for. All right, let's pivot to Section 3, regional performance breakdown and macro resilience. What's great is that this growth was beautifully distributed across the map. Malaysia was definitely the heavyweight driver with a fantastic 9.6% revenue bump, pushing their revenue there to 542.1 million ringgit. Singapore also posted a really solid 3% increase in total revenue when you measure it in local currency. Oh, and we definitely can't overlook their associate company down in Sri Lanka, Lion Brewery Ceylon, which actually delivered a massive 23% jump in its share of profits. Now, there is a fascinating little nuance with the Singapore market here. If you only looked at the top-level reported revenue, you'd probably see a 2.6% decline and start to worry. But that is actually just a currency illusion, driven purely by the ringgit appreciating against the Singapore dollar. The underlying business is actually thriving. Because despite those currency headwinds on paper, their profit from operations in Singapore surged by a phenomenal 14.4%, and that's thanks entirely to lowered operating spend. That is some top-tier cost management right there. I think this quote from Managing Director Stefano Clini really anchors the data in reality. He said, "We delivered a commendable first quarter on favorable Chinese New Year timing, despite heightened global uncertainty and subdued consumer spending." That's a great reminder that these results weren't achieved in some easy economic boom. They were earned through disciplined execution in a genuinely tough, cautious consumer environment. Section 4. Shareholder value and dividends. Let's talk about what this means for rewarding the investor. Now, this is the number income investors absolutely love to see. On the back of this really strong quarter, the board announced a highly attractive 24-cent first-in-term single-tier dividend per share. This is a direct, tangible upgrade from the 23-cent they declared this time last year. It's just a fantastic signal of confidence from the management team. And crucially, this dividend hike isn't just a token gesture, right? It's backed by real value generation. Earnings per share have visibly grown from 30.91 cents in Q1 2025 up to 32.36 cents for Q1 2026. They are literally making more money per share, which gives them a rock-solid foundation to comfortably increase their payout. If you're a shareholder, this is exactly the kind of fundamental health you're looking for. Finally, let's wrap up with Section 5, Sustainability and Future Outlook for Long-Term Value Creation. So, looking beyond just the next quarter's profits, a massive standout point for the quarter is their huge leap forward in corporate sustainability. They achieved an elite upgrade to an AAA rating by MSCI ESG Ratings. I mean, this is huge. It puts them in the absolute highest rating band, officially categorizing them as a leader among global beverage companies. Add in their 4-star FTSE4 Good grading and the rollout of their refreshed Brewing Tomorrow ESG program, and it is crystal clear they're taking their environmental footprint incredibly seriously. Looking forward, management certainly isn't resting on its laurels. They remain cautious about geopolitical tensions and input cost volatility. But their playbook is set. They're going to navigate this macroeconomic turbulence through disciplined value management, really ruthless cost optimization, and pushing their premium brands. It's essentially a dual strategy, right? Defending their margins today while investing in digital transformation for tomorrow. We have covered a lot of ground today, from that 6.5% revenue jump and the longer selling period ahead of Chinese New Year, all the way to the 24-cent dividend and that incredible elite AAA ESG rating. If you want to dive deeper into these official reports or explore their Brewing Tomorrow initiatives for yourself, definitely head over to their official website at www.carlsbergmalaysia.com.my. I'll leave you with this final thought. As companies like Carlsberg pull in record-level ESG recognition right alongside strong financial beats, how will an A++ sustainability rating shape the future of investing in the brewing industry? Does going green definitively mean making more green? Thank you so much for joining me for this explainer, and keep asking the big questions.